So for today's tutorial, we are going to talk about international banking and money market, which is the topic that we covered last week. Okay. So for this topic, as you can see, it's very theoretical. And so you would expect to see these questions, this kind of topic somewhere in the section 3 in your exam, which is the theory section. Okay. So one more thing about this online exam. Now it is going to be a randomly drawn type of question. So I'm going to have a question bank for each of the sections. And I'm going to have a few questions for the theories, for example, for section 3. And it will be randomly drawn, okay? So I might talk a lot about these kind of questions here today. But in your exam, you might see something else, okay? So that's something to think about. Okay, so international banking and money market. Now, let me summarize the question first, the lecture first. So in this lecture, we talk about the services provided by international banks, and we mentioned that they did everything that a domestic bank would do, and they also provide additional services related to international trades or travel, okay? So when we talk about banking, one of the main concerns by the regulators are capital adequacy. And so you need to understand how capital adequacy requirements are set up, what are the 3 pillars, and why are banks required to hold capital, okay? In terms of international money market, we introduce a few instruments for international money markets. So in a nutshell, the function of an international money market is similar to a domestic money market. The only difference is you can trade your currency in a country outside of the domestic country, okay? So in this case, you will call the currency a euro currency, okay? It does not mean that the currency is traded in the euro. It just means that the currency is traded outside of the domestic country, okay? Now, the reason why money market is interesting for this topic is because after the crisis in 2007, we found out that a lot of banks were raising funds in the money market, okay? And by definition, money market instruments are short-term instruments, okay? And so if they use money market instruments, they are exposed to a lot of liquidity risk, okay? So to illustrate the point, if you think about a banking business, what they do is they take deposits from individuals and they lend in loans, okay? So they make loans. So in their loan book, most of the time, they will be lending long term. So if you think about a mortgage loan, it lasts for 20 to 30 years, right? So on their asset side, they've got long-term asset, and on their liability side, if they borrow from money markets, their liability lasts for about 6 months, okay? Which means every 6 months, they are going to have to roll over their liability, okay? And that is why they are exposed to large liquidity risk if they finance their business using money market instruments, okay? So after the crisis in 2007, people realized that it was actually one of the factors that caused the crisis, okay? For this topic, we only have one type of calculation, which is forward rate agreements. And we'll talk about that in example in problem 2 in today's tutorial, okay? Finally, we spent a lot of time discussing financial crisis, and in particular, the 1982 debt crisis in Latin American countries, and also the GFC 2007, okay? So for the purpose of the exam, you need to understand each of the crises. You need to understand the contributing factors, the problems, as well as the responses to these crises, okay? So throughout this tutorial, I'm going to talk about the type of questions that are similar to the type of questions you will see in part C of your exam, which is the theory part. Okay. And for the questions that are not too related, I'm going to be very brief. Okay. So for question 4, for example, this is a straightforward definition type of question. So you would not expect to see this kind of question in section C. Okay. I'm just going to talk briefly about it anyway. So for question 4, what is the difference between the euro note market and the euro commercial paper market? So when you see the word note, you know that we are talking about a short-term instrument. Okay, so a short-term debt instrument. Euro notes are short-term notes written by a group of international investment or commercial banks called a facility. Okay, and a facility could last somewhere from 3 to 10 years. So what that means is that when you have a facility, so let's say I've got a 5 years facility, that means during these 5 years, anytime during these 5 years, I can go back to the bank and say, I need funding. Can you write me a note? Okay. And they will issue a note for me. Now, euro notes are short-term securities, and so they are discount securities, which means that they are sold at a discount from their face value, and the issuer is required to pay back the full face value at maturity. Okay. Their maturity is normally from 3 to 6 months. Okay, so these are very short-term instruments. So what we mean by a discount security is that, let's say if I have a 6-month security, the face value is $100. That means I'm required to pay back my investors $100 at the maturity. Okay, so when the security is sold at a discount, that means when I sell the security, people will buy at a price lower than 100. Okay, so let's say 95. That means for an investor that buy a euro note, they earn a $5 interest on this investment. Okay. Now, euro commercial paper is similar to euro notes. The only difference is that commercial papers are issued in the public market. So this is a public note, public debt instrument. So similar to euro note, commercial papers are discount securities. So their payoff function is somewhere similar to here. And their maturities are also short term, so from 1 to 6 months. Okay. So I need you to remember this feature of a commercial paper so that later on when we talk about SIV, special investment vehicles, and collateralized debt obligations, we understand why they are exposed to liquidity risk. Okay. Okay, let's move on to question 7. Now, question 7 discussed the regulatory and macroeconomic factors that contributed to the credit crunch 2007-2008. Okay, so this is the type of question that you would expect in your exam because this question asks you to discuss an issue. Okay, so you have to show your opinion about a certain issue. So here the issue in question is the regulatory and macroeconomic factors that contributed to the credit crunch. Okay. So if I were to structure this question, my answer to this question in the exam, I'm going to break my answer into 2 parts. In the first part, I'll talk about regulatory factors. In the second part, I'll talk about macro factors. Okay. So with the exam, you don't need to write lengthy essays. That's not the expectation. The expectation is you need to answer the question in a very precise and logical way so that I know that you understand the topic. Okay, so I want to see that you understand the concept rather than copy and paste it from somewhere else. Okay, so you don't have to be lengthy, but you have to make sure that you explain it in the way that shows your understanding. Okay, so let's answer question 7 together. So with the regulatory factors, now you can find the answer here in the textbook. So if you read the textbook, you'll be able to form your answer. And it doesn't have to be exactly the same as my answer, okay? So in the period before 2007, what happens in the US was that the financial sector was liberalized and a lot of the regulations was removed, right? So there was deregulation of the banking sector that allowed banks to open branches around the country. There were also the liberalization of the financial sector, which we'll talk about now, that allow financial institutions to do a lot of businesses, okay? So one such regulatory factor is the repeal of the US Glass-Steagall Act, 1933. So what this act did was that this act separated commercial banking services from other financial services, okay? So basically the act banned commercial banks from providing different other types of financial services, okay? So commercial banks had to only stick to their main business, which is to lend and to take deposits, okay? So around the world, commercial banks tend to be heavily regulated relative to other financial institutions. For example, if you want to have a bank in Australia, you need to have a license to do commercial banking services, okay? If you want to take deposits, you need to have a license, okay? So the reason why regulators are so concerned about commercial banks is because of the fact that they can take deposits from anyone in the economy, okay? So if you think about an average Australian person, everyone has a bank account, right? So when the university pays salary to me, I don't go there and get the cash. I need to give them my bank details and they pay through the bank, okay? So as a result, the bank, Commonwealth Bank, for example, they have all of my savings, okay? So if commercial banks were being too risky or if they were to go bankrupt, then my money is gone, okay? So for an economy, we cannot afford to panic people, to have depositors lose their money and everyone panic, okay? Because that will cause a lot of unrest, as you can see with the current crisis. So as a result, commercial banks were very much regulated relative to other financial institutions, okay? So the intention with this act was to regulate the commercial banks and was to make sure that they did not take too much risk, okay? So as you can imagine, the commercial banks were not too happy about this. So they did a lot of lobbying and eventually they were successful in removing this act, okay? So when this act was removed, what happened was it allowed commercial banks to get involved in more profitable businesses like investment banking services, okay? So if you think about investment banking services, something like M&A deals, so when a company acquire another company, right? If a bank help the company with an acquisition, they will get paid a lot in fee income and commissions, okay? So as a result, this is a very profitable business. So commercial banks were very much interested in investment banking services, okay? Similarly with insurance, brokerage, or financial advising, okay? So when this act was removed, commercial banks had a lot of flexibility in terms of what kind of services they could get involved, which is a good thing for them. But at the same time, it created a lot of problems, okay? So what are the problems that we talk about? Now, firstly, commercial banks were now able to get involved in riskier business. And the effect is that it increases the systematic risk in the banking sector, right? Which is not something that we really want. In addition to that, because of financial innovations like securitization, it allows commercial banks to take off some of the risky loans from their book. So basically, they are able to hide their activities in riskier business like lending to subprime mortgage borrowers. And as a result, they are not, these risky business are not detected, okay? So one of the effects of this activity is that it creates no more incentive for commercial banks to properly screen and monitor the borrowers. Okay, so imagine in the traditional banking business where the bank has to hold a loan for the entire maturity. They have all the incentive to monitor their borrowers, right? They don't want the borrower to default. But as soon as they are allowed to securitize their loans, they are allowed to offload the loans from their book. They have no more incentive to screen the borrowers, right? Because it's not their problem anymore. So this created moral hazard in the system in the sense that commercial banks no longer care about the credit worthiness of the borrowers. In addition to that, because of the removal of this regulation, it creates a shadow banking sector in the sense that lending and borrowing activities are done outside of the commercial banking sector, which means they are done without any knowledge from the regulators. Okay. What is the effect of this? Well, obviously, it makes a lot of risky business going undetected. Okay. So the risk is not properly recognized and it is not properly managed. Okay. So in the current environment, an example of shadow banking is you can think of lending platforms. So these days, if you want to lend to people or if you want to borrow without going to the bank, you can go to a lending platform and you can choose a certain borrower to lend to them. Okay. At the same time, you can go to a lending platform and you can advertise a loan requesting people to lend to you. Okay. So that sector at the moment is not regulated yet, and so it belongs to the shadow banking segment of the economy. Okay. So the overall effect of this ease of regulation is that it increases the risk of the banking sector, and at the same time, it reduces the effectiveness of regulation. Okay, so too much risk and too little oversight, which turned out to be a not very good thing. All right. So moving on to the second part of the question. Now, the second part asks us to discuss the macroeconomic factors that contributed to the crisis. Okay. So the two factors here are an increase in global savings and low interest rates environment. Okay. So similar to what we saw in the 1982 Latin American crisis, in the GFC, in the period before the GFC, there was a lot of global savings, right? There was a lot of liquidity in the sector. Now, the reason is because the emerging economies like China or Brazil or India, in the years before 2007, they have increased a lot of wealth, right? They have accumulated a lot of wealth as the economy grew. So when they accumulated wealth, they were looking for different ways to invest their wealth, okay? And a large part of their investment went into the US. Now, the problem of that is that it created a lot of supply for money in the US, and so it makes borrowing in the US very cheap, okay? So there was a low interest rate environment. So over time, after the crisis, as more people were, as more research unfolded, we found out that when the interest rate is very low, it created some unintended consequences. Okay, so for example, if you think about mutual funds or hedge funds or other financial institutions, investment firms, they have to invest money, right? So when interest rate is high, they can afford to invest in safe assets like bank deposits or investment grade bonds. But when interest rate becomes very low, they have to take more risk to be able to earn more returns. Okay, so when interest rate is lower, you will see that a lot of financial institutions, they started to make a lot of risky investment. Okay, hoping to reach to higher yield. Also, at the same time, because the banks were awash with money from overseas, they started to look for alternative ways to make loans. Okay, so one of the ways that they did so was to lower the lending standards so that they can lend to more people. Okay, and it was the reason why subprime mortgage loans started to increase. Okay, so as banks lower their lending standards, they started to lend to more subprime borrowers, and they increased the number of subprime loans in the sector. At the same time, because it's cheaper to borrow money now, it encouraged people to buy houses. So as the demand for houses increased, it increased the house price as well. Okay. So what is the effect of a higher house price for banks? Now, if you think about a mortgage loan, the bank uses the house as the collateral. Okay, so when the person defaults on their loan, for example, the bank will take the house and they will sell off the house to the market to recoup the money. Okay, so when house prices are very high, the collateral value of the house is high, and that gives the bank even more confidence to lend to subprime borrowers. Okay, because even when they default, the banks are not going to lose with the current house price. In addition to this factor, in addition to the oversupply of liquidity, the US government at that time also maintained a low interest rate environment. So from 2000 to 2003, the US Federal Reserve, which is the central bank, they decreased the cash rate from 6.5 to 1%, right? That is a very huge decrease. And the reason was the US in 2001 experienced a dot-com bubble where a lot of technology companies went into bankruptcy, okay? So to boost the economy following that recession, the US Fed Reserve Bank decided to reduce their cash rate, okay? So as a result, it makes borrowing cheap, and therefore people were encouraged to borrow more. Okay, so besides borrowing to buy houses, they also borrow to consume. Okay. In addition to that, the U.S. government at that time encouraged home ownership by lower-income households through subsidy programs. Okay. So this further increases the demand for houses and therefore home mortgages. So the total effect here is that it created a large pool of mortgage loans, which encouraged the banks to write securities and sell off to investors. Okay. In addition, and more importantly, it created a lot of lower quality loans. Okay, which is the subprime mortgage loans. And that was the cause of the problem. Okay. So if I were to answer question 7 in the exam, this will be my answer. Okay. So as you can see, I don't use a lot of, I don't have to write an essay. I just use a lot of dot points. Okay. So as long as the answer makes sense and as long as it answers the actual question, then I'll be happy about it. Okay. All right. Moving on to question 11. So for this question, I moved question 11 earlier because you need to understand a mortgage-backed security to be able to answer the other two questions. Okay. So what is a mortgage-backed security? So once again, this type of question is a straightforward definition question. So you would not expect this question in section C of your exam. Okay. So a mortgage-backed security is a security that is written on a loan, on a mortgage loan. So this is a derivative security because its value is written on an underlying asset, okay, being mortgage loans in this case. Each mortgage-backed security represents a portfolio of mortgage, and they come into different tranches, okay. So to illustrate, let's look at a simple example. So let's say I just go to Commonwealth and I ask them for a mortgage loan for $500,000. Okay, so they give me the loan, and on the book they have a mortgage loan in their asset portfolio. Now, suppose Commonwealth doesn't want to hold this loan on their book. What they can do is they can write a bunch of mortgage-backed securities backed by the mortgage loan. Okay, so let's say they have 3 different tranches. The top tranche is a AAA tranche. The second tranche is a BBB tranche, and the last one is unrated. Okay, so this is what we call a pool of mortgage-backed securities. So this is a portfolio of mortgage-backed securities. So they are backed by the original mortgage loans. Okay, so the top tranche has the lowest credit risk, followed by the second and then the last. Because the top tranche is safest, they have the lowest promised return, let's say 5%. The second one has a little bit higher credit risk, so they are promised 7%. And the last one is very risky, so they are promised 10%. Okay. So suppose in 1 year's time, Commonwealth Bank revalues their loan and they find that after 1 year, the loan deteriorates and there is a loss of 100,000 on the loan. Okay. So under this structure, the first person who bears the loss is going to be the unrated tranche. After this tranche is wiped out, the second tranche will be bearing the loss, followed by the last tranche. Okay. So as you can see with this structure, the lower tranches bear the more losses. Okay. All right. Question 9, what is a structured investment vehicle and what effect did they have on the credit crunch? Okay, so this question could be an exam question because it asks you to discuss the effect of something on the credit crunch. Okay, so to discuss the role of the special investment vehicle on SIV on the credit crunch, let's look at how they contribute to the securitization process. Okay, so on this graph here, I've got 4 parties to a securitization process. I've got the originating bank, I've got the borrower, who are the original parties to the mortgage loan. So the bank lends to the borrower, let's say $500,000, and the borrower promised to pay back the bank. Okay, so this is a loan on the bank book. Now, once the bank has the loan, once the bank creates the loan, they are going to securitize the loan. Okay, so how do they securitize their loan? They are going to create a subsidiary called a special investment vehicle on SIV. So this is a subsidiary of the bank, and they are going to sell the loan to the SIV. Okay, so as they sell the loan to the SIV, they effectively take the loan off their book. Okay, so the loan is taken off the record. In exchange, the SIV is going to pay the bank for the purchase of the loan. Okay, so let's say they pay $500,000 as well to the bank. Now, the SIV is then going to use the loan to write a bunch of mortgage-backed security and sell them to the investors. Okay, so here the loans are used to write mortgage-backed securities and sell to the investors. The investors in exchange would have to pay the SIV. Now, suppose when the SIV sells the mortgage-backed securities to the investors, they are going to charge a fee, right, which is 10% on the face value of the loans. So in this case, the investors is going to pay the SIV $550,000. Okay. So through this process, the SIV earned $50,000 in fee income, okay, through the securitization. Now, essentially, through this process, you can see that the loan ownership has been transferred from the bank to the investors. So through the securitization process, it essentially makes the investors the lenders to the borrowers. And so the contract, the loan contract, is essentially between the borrower and the investor, okay? So as a result, the investor is going to be bearing the default risk of the borrower, okay? So this is a key feature of securitization, and the securitization process is enabled through the use of an SIV, okay? So from a bank's point of view, the reason why they want to use an SIV to securitize is because by using the SIV, they can take the loan off their book, so they don't have to worry about capital requirement on the loan. So they free up their capital for further investment, okay? Second, when they take the loan off the books and sell it to an SIV, any kind of liabilities on the loan is now with the SIV, okay? So the bank assumes no more responsibility on the loan, okay?
I have a question.
Yes.
Where does the repayments go? Do the repayments still go to the bank, or do they go to the investors?
So the repayment will be paid by the borrowers to the bank, who would then transfer to the SIV, and it will go to the investors eventually.
Okay, cool. Thank you.
Thanks, Michael. Okay, so that was the role of the SIV in securitization. Now, in terms of the SIV, let's take a closer look at their business model. So we mentioned before that on the asset side, they buy mortgage loans from the bank, right? So on their asset portfolio, they've got a bunch of mortgage loans. So by nature, these are long-term assets, yeah? So the mortgage loans last for 20 to 30 years. So these are long-term assets. The SIVs, on the other hand, finance this purchase using commercial papers, okay? So on their liability side, they raise funds using commercial papers. By nature, commercial papers are very short-term securities, okay? So very short, about 6 months. So when the U curve is upward sloping, so when we say the U curve, we are talking about a curve that describes the interest rates of short-term securities versus long-term securities, okay? So for example, this is a U curve between a 1-year security and a 30-year and a 20-year security, okay? This is time and this is interest rate. So with an upward sloping U curve, which is what we have here, short-term securities are always less expensive than long-term securities. And as a result, for an SIV, when the U curve is positive, they will earn a positive interest rate spread, okay? Because they borrow cheaper and they lend more expensive, okay? Now, what is the problem here? The problem here is that they've got a very big mismatch in their liquidity, okay? On their liability side, they've got to roll over their liability every 6 months. On their asset side, they've got a very long-term asset, okay? So if they can roll over their securities, their commercial papers every 6 months, they will be fine. But as soon as the commercial paper market stop, they will run into a funding problem, okay? And that was exactly what happened in the financial crisis, okay? Now, the second problem here is that on their asset portfolio, they invest only in mortgage loans, okay? So their only asset type is mortgage loans. And what is the problem with that? They have 100% exposure to the default risk in the mortgage market, Okay, so when something happens to the mortgage market, they run into trouble. Okay, and that was what happened as well. So one more thing before we answer the second part of the question. Now, what happens when borrower defaults? Okay. So we know that SIV packages their loans and sell them off to investors. So the process is like this. We've got a mortgage borrower who pays to the bank, who then pays to the SIV, who will then transfer the money to investors. Okay. So what happens when the borrower default, right? So when they default, they will not pay the bank, who will then have no money to pay the SIV, who will then not pay to the investors. Okay. So the ultimate loser in this case will be the investors because they hold the mortgage. Okay. So when the investors hold 100% ownership of the mortgage, which means when they buy off all the mortgage tranches, then they bear 100% of the loss. Okay. Alternatively, if the SIV only manages to sell 50% of their portfolio and the other 50% remain unsold, then in this case, they will lose 50% and the investors lose the other 50%. Okay. Now, what is important for banks here is the fact that the SIV is a subsidiary of the bank. So in the worst case, when they default, the losses will be borne by the bank itself. Okay. So even though we said that through the securitization process, the banks basically take the loan off their book and they have no more responsibility of the loans. But in the case when the SIV have not sold all of the mortgage-backed securities, and if they make a loss, the bank will eventually have to recognize the loss. Okay. Okay. So having understood what SIVs do and what their roles in the securitization process is, what do we think is the effect they have on the credit crunch? So number one, we said before that the banks use SIVs to create a lot of risky loans, right? So the SIVs therefore enable banks to create a lot of risk without being detected, okay? Because the loans are taken off the book. So the bank's actual risk exposure in mortgage-backed securities is essentially unknown until they have to recognize actual losses, okay? So until it's too late. Second, because SIVs sell the mortgage-backed securities to everyone, so they enable risk to be transferred across the financial sector, okay? In addition to that, we have understood how they funded their purchase of the mortgage loans, and we have seen that it created a lot of liquidity risk, right? So through their structure, they created a lot of liquidity risk in the sector, okay? Okay, so moving on to question 10. So what is a collateralized debt obligation and what effect did they have on the credit crunch, right? So with a collateral debt obligation, this is an entity, so it's like a company, right? And what they do is they hold a portfolio of fixed assets, okay? They would then use this portfolio as collateral when they issue securities, okay? So when we see the word fixed income, we know that we are talking about debt instruments, okay? So fixed income are interest generating income. So they normally are debt instruments. So in the mortgage market, the type of fixed incomes that CDOs hold are mortgage-backed securities. Okay. So the structure of CDOs are somewhat similar to SIVs. So their business is they will go and buy mortgage-backed securities, and they will use that to issue securities to sell to investors. Okay, so they will write securities on these securities and they sell them to investors. So the mortgage-backed securities that they bought at the first stage is used as collateral for the securities that they sell to investors. Okay, it's a bit complex, but the idea is the same. You try to make money on mortgage-backed securities. Okay. The portfolio of fixed income assets is similar to SIVs. They will be divided into different classes, and investors, depending on their risk preference, they will buy the class with low or high risk. Okay. So CDOs is one of the major investors in the mortgage-backed securities besides SIVs. And what's interesting is that CDOs have been around for a long time, and they have always been specialized in the lower quality tier of financial securities, right? So before mortgage-backed securities, they were investing a lot in junk bonds. But when the subprime mortgage loans became abundant, they started to specialize in subprime mortgage loans, okay? So in terms of their funding structure, similar to an SIV, they tend to fund their business using commercial papers, okay? And the reason is, as we mentioned before, in the period before the GFC, the interest rate is very low, okay? So by issuing commercial papers, they get very low interest rate, okay? This is CDO. So what effect did CDOs have on the credit crunch? So the answer here is similar to the previous question. So when everything went well, when the interest rate is very low, they got to borrow at a lower rate, and then they lend to a higher rate using mortgage-backed securities, right? But the problem started to happen when the US central bank decided to increase interest rates, okay? So from 2003 to 2006, the US central bank has increased interest rate by about 5 times, from 1% to 5.25. Okay. So for a normal person with high income, so on and so forth, it will be a lot harder to pay off, but they will still be able to pay off. Okay. And also with the high interest rate, they are discouraged from buying houses, and so the housing market cooled out. Now, the people that were hit very hard by the increase in interest rate are the subprime borrowers, right? So these people were lower income borrowers, and with a 5 times increase in interest rate, it became impossible for them to pay off, okay? So as they found it difficult to pay off, they started to default on their mortgage loan. And so the default rate of mortgage-backed securities started to increase, okay? So if we remember from the previous slide, we said that the people that invested a lot in subprime mortgage-backed securities were the CDOs, okay? So they were specialized in the subprime mortgage market. And so as these subprime borrowers defaulted, they were the first to get hit, okay? So their asset size started to decrease in value, okay? So as people realized that the CDOs asset portfolio became deteriorating, they started to stay away from CDOs, right? So that means on the funding side, they were not able to raise any new fund. They were not able to roll over the commercial papers. And on the asset side, no investors were willing to buy CDOs anymore, okay? To make the matters worse, the credit rating agencies decided to downgrade the CDOs because the asset value has lost their asset value has deteriorated. Okay, so that further trigger the crisis that the CDO is already faced, and as mortgage-backed securities further defaulted, they got into even more severe problems. Okay, so eventually, as we all know, a lot of them defaulted. Okay. All right. So that was the theory questions for today. And as we mentioned before, it will be important for your exam, okay? So this topic is very theoretical, and so you would expect to see it in your section C of the exam, okay? Moving on to the calculation. So for this topic, we have one type of calculation only, which is the forward rate agreement. So for this calculation, you would expect to see this in the multiple choice section, okay? So with forward rate agreements, when you see a 3 against 6 forward rate agreement or FRA, it means that this is a contract that will be settled in 3 months, right? So this contract is settled in 3 months, and the interest rate is going to be calculated for the period between 3 months and 6 months, okay? So here is the period over which I'm calculating my interest payments, okay? So for a FRA calculation, you will need 2 interest rates. You will need the agreement rate in the contract, which is what we call AR. So in this question is 5.5%. And then you will need the actual spot interest rate at the time of the settlement, okay? So here, assume that the 3 months from today, in 3 months' time, the settlement rate is 4/7/8, okay? So at this time, the spot interest rate is going to be 4.875, okay? So for this calculation, determine how much the FRA is worth. So how much the FRA is worth is equivalent to how much the parties to the contract will settle the contract. So to compute how much the FRA is worth, you can use the formula that we saw in the lecture slides from last week. I can show you here. All right. So for this calculation, this is the formula that you're looking at. Okay. So your job here is to just put the correct numbers in the correct places. Okay. In addition, you need to determine who pays who, the buyer or the seller. Okay. So for that, you need to rely on the payoff functions of the 2 parties. Okay. So let's take about 5 minutes on this question. I'm going to get some water, and when I come back, we will talk about the answer. Okay. Okay. So I have launched a poll where I've got a question for you. So I've got 4 answers now, and I'm waiting for 2 other people. So for this question, we've got a very divided answer. So 2 people say buyer pays seller, and 2 people say seller pay buyer, right? So one way to determine who pays who is you can look at your lecture slides. I've got some information there. Or if you like to visualize things like me, then I'll start with this graph over here, where I have the payoff functions for a long and a short FRA, okay? So a long is a buyer and short is a seller, okay? So here, when the spot exchange rate is less than the agreed rate, so we are here, then you can see that the buyer is making a loss and the seller is making a gain, okay? That means in this situation, the buyer is going to pay to the seller, okay? So buyer is the loser and the seller is the winner. So here, buyer pays to seller. Okay. Now, second question, how much is the FRA worth? Have you tried to do the calculation? And if so, what is the answer? Okay. Yep, I've got an answer here. Larissa said 4,732.71. Spot on, Larissa. So this is the answer that I got here too. So what we did here is we just have to apply the formula that we saw before. So this is my notional amount. This is my SR. This is my AR. This is T, which is 92 days, 365. And then I have the present value factor here with SR and T. Okay. So if I do so, I will find that the answer here, there should be a negative sign here. The answer here is 4,732. So this number tells me that in 3 months' time, when the FRA contract is settled, the buyer is going to pay to the seller $4,732. Okay. Now, moving on to the last question. So in this question, assuming that everything else stayed the same, the only thing that changes is the settlement rate. So in the previous question, the settlement rate is 4.875. In this question, let's assume that the settlement rate is 6.125. Okay, percent. What is the solution now? So in this case, we've got a situation where, oopsie here, where the future spot interest rate is greater than the agreement rate. So in this case, it's 6.125. So in this case, the seller makes a loss and the buyer makes a gain. Okay. So as a result, under this situation, the seller is going to pay to the buyer. Okay. And how much do they pay? They are going to pay 4,717, okay, which is given by the same formula. The only difference is I change the spot rate here, okay. Okay, any questions with this calculation at all? If not, I'm going to conclude the class for now. Thanks guys for joining in today, and I'll see you later at 4 p.m. for the lecture. Okay, bye for now guys.